Hello everyone, and thank you for joining us for today's webinar. My name is Diana Ospina and I'll be your host for today. Today's topic is Accounting for Asset Leases, the New Way. This is presented by Kent Bettisworth. Kent is the President and CEO and Executive Consultant at Bettisworth and Associated. Kent provides advisory expertise in project management, including new revenue recognition solutions, portfolio management, and fixed assets, to name a few. He has over two decades of experience implementing and managing information systems and designing and delivering training. Now, without any further ado, I will pass this over to Kent to begin the webinar.
Thank you, Diana. You're going to make me the presenter, and then I can show my screen, and we'll get started. Thank you, everyone, for joining today on a Friday. It's probably pretty cold where most of us are at these days. I'm down in Houston, and it's pretty cold here. So we want to talk about this lease accounting and the new way. And what I mean by that is it has been a topic that's been discussed for a number of years between the international accounting boards and the U.S. boards. They all agreed that there's trillions of dollars that are off balance sheet. We've got lots of different examples we can talk about where this has been an issue, but the idea was that we wanted to bring, that the accounting boards wanted to bring more visibility to what's just a footnote today and bring that up into the balance sheet rather than just an operating expense, so that investors would have a better idea. So this new standard has been adopted by both international accounting and U.S. It is effective beginning with 2019. I've got a slide a little bit later that will give you more granularity on exactly when in 2019. And specifically, we're going to talk about what are the new rules, what's different between the U.S. and the rest of the world, and there are some significant differences. If you have been hearing and reading about the revenue recognition new standard, those are similar, if not exact. This one is not. And I also want to provide you with some ideas on what you should do to prepare. Even though 2019 is far away, it's really not that far. So my first poll question that's out there is, does your company have an active project to implement the new lease accounting standard, yes or no? And the second poll question is, if you do have a active project, what stage are you in? Just getting started, initial eval, design, build, or test? And Diana, can you see the results of the polls?
No, the results are not in yet.
Okay. So we'll come back to those as we proceed forward, and Diana can see that information, share it with you. My guess is not very many people have started. And the message in this presentation is it's not too early. And you'll see why in just a minute. A couple of terms. As you see these acronyms throughout the presentation, just wanted to remind you, ASC is the Accounting Standards Board. Let's see here. Can you still see my screen, Diana? Okay, I'm assuming you can still see my screen. The International Accounting Standards, IASB is the International Board, and IFRS is the acronym that's used for the new accounting standards that have been issued by the international boards over the last number of years. From the U.S. side, we have the Financial Accounting Standards Board, commonly referred to as FASB, and of course the SEC is listed here because the SEC has an oversight role to ensure that the financial statements are reflecting what's happening in a company, and investors can ensure that they understand what's happening. And particularly, you may have heard in the recent months, a number of companies will often talk about their business using non-GAAP standards, and the SEC is starting to take a pretty dim view of that because in a lot of cases they don't believe that adds to an investor's transparency and understanding. It actually just confuses them. This standard, lease accounting, is meant to add transparency and help investors understand. So let's talk about this. It was approved in February, really to add the clarity get some comparability across companies because today it's pretty complex. The new standard ensures that the assets and liabilities are reflected. That's new. Today you only see typically operating leases in the income statement as a lease payment, and the capital leases are the only thing you see on the balance sheet. With this new standard, operating lease assets will be added to the balance sheet along with the liability. This standard was also designed to be consistent with the new revenue recognition standard, which is effective at the beginning of 2018. So what does this look like in the U.S.? It's the accounting standard 842. I want to talk about the model, some key differences between today and this new standard, an example, and some transition comments. So who's affected? Well, it's anybody who enters into a lease contract, buildings, equipment, except not intangibles, not oil and gas leases, for those of us who are in the oil and gas business, not biologic, not inventory, not under construction. Or, and here's your first rule that you can apply, it's not less than 12 months and or it's not below a capitalization threshold. So we'll talk about that threshold here in a little bit. How do you apply the principle? Well, you have to identify your lease at inception, and you have to classify it as either operating or finance. You'll find in a minute in international that's not required anymore. So it typically is a physical asset. You have the right, you as the leasee, have the right to control and direct the use. And this is really important, this third bullet point. You now need to look into service contracts and carve out any that have a piece of equipment or a building that's wrapped in an overall service contract. Just to give you an example, if you lease a cell phone for your business and you get a subscription, you're paying a subscription fee, and let's assume that cell phone was a really expensive one and it was higher than the threshold, you would have to carve out that cell phone or that PC or that car and separate it from any support services. That means you have to go back to your lessor and talk to them about what is the value. You'll see this in a minute. That's what I mean about the changes that are coming. This conversation, not many people understand, is going to need to be had. So you have to separate that lease equipment from the non-lease, the service piece. And you have to now record on your books at the adoption of the new standard an asset called a new asset, new kind of asset. So in SAP world, a new asset class. It's a right of use asset. You're going to book it at present value. I love that term. You're going to amortize it over the lease of the life of the lease, and you're going to record a offsetting lease liability and then reduce that liability as you amortize. So some things you have to know is, what are my lease payments? So if you go back to that service contract and there's a piece of equipment embedded in it, you don't know what the lease payment is just for that piece of equipment. So you've got to go back and talk to the lessor. You need to know the term. That means you need to know not just the initial term, but what's the probability that I'll extend it. You need to include the life of all the most likely extended terms. So you could have a 2-year term with an option to extend 3 more times at 2 years each. You need to assess the probability. So that word assess means, yep, management judgment. This is rolling now more into the U.S. side of the world. The international has always been doing this. You need to know what the interest rate is so you can calculate the present value. So here's a slide that walks you through at a high level this discussion. So have you separated the lease component? Is it an identified asset? Do you have the right to control the use? Is it explicitly or implicitly specified? Is there no practical ability to substitute? Do you have decision-making authority? Do you obtain the economic benefits? So specifically for operating leases, and this is where I think the biggest impact is on most companies who are lessees, you have to calculate that single lease cost. Interest plus amortization. Amortization is the straight line expense less the interest for the period. You need to allocate over the lease term, which means you need to identify that lease term and all the options to extend. From a reporting perspective for disclosures, the cash payments will be classified as operating activity cash flow. The finance leases isn't changing that much, maybe a few nuances, but if you're doing finance leases today, that'll continue tomorrow. There's some changes potentially around the revenue recognition model that affects that, but I won't go into specifics about that here. So here's a comparison. On the left-hand side, the new standard, ASC842. It's replacing on the right-hand side, ASC840. So as you see on ASC840 today, you separate, but only if it's 25%. If it's a capital lease, if the lease term goes longer than 75% of the asset life, and or if the present value is more than 90% of its fair value. Now, so there's some rules in 840. Look on the left-hand side. There are no percentage rules for calling out land, calling out whether it's a capital lease. The rules are you do have to identify them separately. Now, it still is about, is it going to last longer than, or a greater percentage of the asset life? Is the value more than 90%? But those percentages are not called out in the standard, which means it will be up to the judgment of management as to whether it's a capital or an operating lease. Most likely you'll continue doing that split, but you may find that you choose to do otherwise. So you need to be assessing this, talking to management, discussing it with your auditors to see if you're going to make a change. You have to assess those contracts, all of them, and look for the embedded leases. So you have to carve that out. And so the factor is not these percentages and the values. It's, do you control it? Is it physically identified? And then to put it on the balance sheet, you have to calculate its net present value using the lease payments over however many terms you think you'll have it. So this is the first time, and you'll see an example here in a minute, this is the first time where the asset value is not the, quote, cost. It's a present value calculation using the sum of all the lease payments over however many terms you have, including extended, discounted back at a rate that's specified in the contract or one that you imply from your cost of capital. You'll still show operating lease as a single lease expense on the income statement. Finance leases will be separated between interest and amortization. Now, there's a lot more to it. Here's a quick example. I'm not going to read all of this to you, but I just want to call out some of the things on the on this example. So if you just read this, this is an apartment company that's got a 3-year lease of office, and they agree to pay $10,000 in year 1, $12,000 in year 2, and $14,000 in year 3. That's a total of $36,000. There's no other complications in this, so it's a 3-year lease for $36,000. So the right to use asset, this is the first thing that has to be the accounting entry. You're going to add an asset to your balance sheet valued at skip one part. It's $36,000 over 3 years, but you need to discount it back at 4.235. That's what the contract says, or that's what the company's cost of capital is. So that gives you a value of $33,000. You add that to the asset balance sheet, you put an offset for the lease liability. That's brand new. That calculation isn't in your existing SAP asset system. Now, over on the right-hand side, your first-year journal entries would be you've paid $10,000 of cash, right? But the straight line amortization of that $36,000 over 3 years gives you a lease expense of $12,000. So you have an additional entry against the asset of $2,000, and you reduce the lease liability $8,602. And you're going, Kent, where did that number come from? I can't back into that in any kind of simple mathematical equation. But what you have to know is that 8602 is the present value of the liability at the end of year 1. It's the amount that you reduce the liability. So if you look a little bit further down on this bottom chart, you see that if you're looking at the balance sheet side, here's your lease asset for 33. You have you've reduced it to 24,398. That's the present value of that lease liability at the end of year one. Okay? I know. You're going to have to think about that tonight. The finance lease is essentially the same. You would have your right of use asset on with the lease liability. You would have, but here's the difference. You would have interest expense, not lease expense. And the asset would be also amortized, the $33,000 times the 4235. I'm sorry, that's the lease expense. And you would have the asset of $33,000 being divided by 3 years, so it's $11,000 a year. So there's amortization plus the right of use asset, and then you have the cash payment for the first year of $10,000. You calculate the amortization of this capital or finance lease, but you still have a finance lease, which is not any different than today. So here's a slide that gives you a comparison between the balance sheet entries and the for each year and the income statement entries, and comparing finance to operating lease. At the end of the 3 years, they all add up to the same in terms of expense. So the impact on your income statement at the end is not any different, but the amounts are different because of the way it's being calculated between using this present value and the interest on the finance lease. I know this is so. My point is, it's more complicated than you might imagine. There's 2 choices on how you adopt. There's a modified retrospective that you can choose. The idea is that you apply the new guidance at the beginning of your earliest comparative period. I'll talk about that in a minute. Basically, if you adopt on 1/1/19, your first comparative period would be at the end of your first quarter in 2019. That's when you would need to start explaining. You would start explaining how the new standard differed from the old. So that would mean any variation on the lease expense that you book today versus the lease expense you're going to book tomorrow, as well as the change in the balance sheet with these new assets. That's what you'll be explaining so that investors understand. You can simplify it using these practical expedients. Practical expedients mean we're trying to make it easy. So, for example, you don't have to go look at those embedded leases unless they're significant. You need that agreement from your management and your auditors. You may not need to reassess at the point of conversion those that you've called operating versus finance, only the new ones going forward. You don't need to look at it indirect cost. I'm sorry, initial direct cost. That's about, there may be some cost with acquiring a lease that you end up having to capitalize instead of expense. And this issue of what's the probability that my options to extend will actually happen, you can start doing that going forward. You don't have to look back. You can assume that your assumptions looking back were accurate. So what about international? Let's look at it from the same way. Who's affected? Same folks. You're excluding everybody that enters a lease except intangibles, oil and gas, biological inventory, or under construction. If it's less than 12 months, so that's the same. Here's the difference at this level. We said capitalization threshold for the U.S. Low value is the term that's used internationally. In the discussion and the writings about this standard, $5,000 was suggested as a low value, but it's going to be a management judgment. So here's the deal. If you're an international company and you have both, and you're based in the U.S., you have statutory reporting internationally. Well, in the U.S., your capitalization threshold may be $10,000. So a lease that's less than $10,000 you wouldn't show. But internationally, that same lease, the threshold may be $5,000 because of certain country statutory reporting. So now you need 2 sets of books to track the right to use asset on the international books, but it's not on the U.S. books or the U.S. GAAP books. Okay, so you have some of that going on today in assets in other areas, but this one really is going to expand that perspective. So how do you apply it? It's very similar. You identify the lease at exception, Do you as the leasee have control, and can you direct the lease? You do have to evaluate for embedded leases. You're going to record that right to use. Sorry, let me go back up. You're going to include that right to use asset at a present value amortized over the lease life and record a lease liability. So that part's the same. However, notice that I did not say there was a finance lease. There is no finance lease going forward in international rules. If a lease is a lease is a lease, unless it meets one of these exceptions right here. Okay? So let's compare what that really means. IFRS 16 is on the left. That's the new standard. On the right is IAS 17. So today it's not limited to PP&E. Building and land is considered separately unless the land is immaterial. Notice there's not a percentage bright line rule there. Finance capital leases if it extends over the major part of the asset life or the fair value is greater. So pretty much the same language that the U.S. uses today to identify a capital lease. Well, guess what? That completely goes away when you adopt this for your international. Now, every lease is a right to use asset, and it's a liability, unless it's 12 months or it's that low value. Okay? So, yes, you must separate leases that are embedded in a service contract. There is no separate finance lease categories, I keep saying over and over. And you're identifying that lease asset where you have control, including substitution rules and the like. So here's an example. In this case, upper left, I'll just highlight it really quickly. You have a telecom that's leasing some telecommunications fibers for 3 years. Same numbers, $10,000 lease payment in the first, $12,000 in the second, $14,000 in the third. Same 4.235 discount rate. So at commencement, they put an asset on the books, $33,000, offsetting liability for $33,000. Then in the first year, there's going to be an interest expense and a depreciation expense. In the U.S., we call that a lease expense and a amortization expense. Okay? So there are some of the differences. If you follow this through, and I would encourage you to take a look at this slide when you have access to the presentation from Diana, and look closely at these T accounts and compare them to what you do today, and you will start to see that basically what's changing is you're getting a timing difference. And it's that timing difference, first off, that you will have to explain. And then secondly, that timing difference is also going to be associated with all those capital leases that are now going to be right to use assets. So you have a conversion exercise there. And the calculation for them may present a timing difference over the life of the lease. So if you're getting the idea that there's a lot more to this than just adding up lease payments, dividing them by the life of the lease, there's a whole lot more to this. In the transition, internationally they gave you a choice between a full approach or a modified. So the full approach essentially says you start a couple of years early. And you're showing the comparisons early up until the day you make the adoption. Modified means you don't start explaining the comparisons until you adopt. There is a practical expedient internationally which says you don't have to reassess existing contracts. You can just start this from day one. So while there may not be a big data conversion exercise, there is certainly a procedural exercise with your business to now bring more rigor around that process for identifying leases. Again, some more words around that retrospective approach. If you do take the full retrospective, you're applying it to all the prior periods because this is a change in accounting estimates. And you're going to adjust your balance sheet for these changes at the beginning of the earliest comparative period presented. Modified, as I said, means it's a cumulative effect at the adjustment at the effective date, and you can reduce what the impact of that is by applying the practical expedience on a lease-by-lease basis. So let's compare the two between international and the U.S. So from a definition perspective, I've got U.S. on the left and the international on the right. U.S., I have separate guidance for finance and operating. International, I do not. Land can still be treated as a separate lease. On the international, no. There's no requirement to separate. You could take management judgment and do it. Generally in the U.S., it has to be a physical asset that can be identified. Internationally, it does not necessarily have to be a physical asset. It can be implied. So if you think about fiber optic cable in a building serving multiple tenants, which fiber belongs to you? Well, you probably don't have a specific strand of fiber in that cable, but there is an implication that one of those fibers is providing you the access, and that's your physical asset. From a measurement perspective, there's no implicit low value. The suggestion was to use your company's capitalization threshold, whatever that might be. Internationally, the suggestion was that it be less than 5,000. And I think that was a USD value that they were using. It does allow you internationally to have an alternative basis for calculating the value. Variable payments, when you take into account your variable payments on the lease, if something changes, US-wise, you're not going to redo your right-of-use balance value. Internationally, however, let's say that your lease payments are indexed to inflation. And so that means you have an idea of what inflation will be, and there's a chart that tells you what the company is going to increase your rate, but they may come back and say, oh, we're changing that. Internationally, if they change your index rate versus from the original contract, you have to come back and make an adjustment to your balance sheet and your liability account. Private companies, there is separate private company guidance in the U.S., but not internationally. Statement of cash flows, we've got interest is operating activity, amortization is financing activity. So this goes to how you segregate your disclosure information. Internationally, you have an option on how you classify interest. It could be one of three things. So again, some nuances between the two standards. You don't see this in the revenue recognition. It's essentially the same. Now, impairment, on impairing these right-to-use assets, yes, you have to apply that standard. It's a different standard, and it's got some different rules between international and FASB. And then from a transition, you can adopt early in the U.S. if you choose to. Internationally, if you adopt early, you also have to be adopting the revenue recognition standard, which, quite honestly, that's about to be overcome by events, because on 1/1/18, most people are adopting the revenue recognition standard anyway. So what's the impact? Let's look at the transition dates. If your year end is December 31, that means you're adopting on 1/1/20. That means your first quarter, when you report on it in April of 2020, you're going to be explaining these changes, these variances between the old and new standard. Okay? If your year end is March 31st, then that means when you adopt on March 31st of 2020, the end of your first comparative period will be in June 30, and you'll explain it in July of 2020. So that sounds like a long way away. That's 3 years. But depending on your full retrospective or modified, you may find you need to start analyzing these variances at the beginning of next year or the beginning of 2018. So if your year end is December 31st, for example, you'll have a comparison, in other words, a parallel income statement for 2017, 18, and 19, looking back, so you can help investors understand what's changed. Who's really impacted the most? Well, take a look at this list compiled by a company out there called Lease Accelerator. If you look down the left-hand side, you see Walgreens, AT&T, CVS, Walmart. So what you see is big grocery store companies. You see the big cell phone guys with the cell phone towers. You see people with trucks, FedEx. You see Bank of America, so think retail locations and ATM machines. There's two airlines, United and Delta, so think airplanes that have been leased. And so you kind of get the idea. So these are the folks that are impacted the most. If you look at the right-hand side and look at that total operating lease, not talking capital leases, but operating lease payments, these are just an income statement amount with a footnote today. We're talking $33.7 billion of operating lease for Walgreens. They've got a huge exercise to add these leases to the books, both building leases as well as equipment leases. And you can go right down the line. Now, this is only 20 companies. Think about everybody else that's out there that's, that has leases. So impact business process, you're going to create an initial load of high volume assets. It's going to be based on a different kind of calculation than you've ever seen before relative to assets. It's this present value. Income statement, if you're the leasee, you may find some differences in your income statement because your lease expense might go down, but it's going to be partly offset by interest and amortization. If you're the lessor, there may just be some timing because your revenue from interest is going to get spread out, and because you're having a longer lease life that's in the assumptions. I think I didn't put this in here, but the other impact is you're going to have a different kind of dialogue with your lessor because you need information from them, particularly on the embedded lease contracts. Balance sheet wise, your ROI could be reduced because you now have these right-to-use assets. Because you're putting an offsetting liability, the net book value, the net is not changing, but it depends on what those covenants are that you have with banks on what, are they looking at net assets or are they looking at just total assets? And then your disclosures. You're going from a few lines in the footnotes that simply spell out what your lease obligations are in dollar amounts for the next 5 or 10 years to actual entries in the assets and liabilities part of your balance sheet, along with very extensive qualitative and quantitative explanations of the judgment that you applied. For example, how did you decide that even though your contract says you have 5 options to extend this, each option being 3 years, you decided to only spread the asset over the first lease of 3 years? You'll have to explain that, okay? So this is where talking to your auditor is the most important. Well, that's not, okay, I'm going to come back to that slide. So what you need a project team and a clearly defined charter. You need to start talking to your investors, employees, lease vendors. Talk to the advisory groups in FASB and internationally about application of this standard. Understand what the impact is from a tax perspective. Understand what the impact is from a process perspective where you're going to need new training. And particularly look at your systems. What new systems are you going to need? And you will need some new systems, and that means some new controls. So you need some experts looking at your classification changes, looking at your existing asset leases, estimating the financial impact. And as with any change, there's an opportunity to see, do you need to improve that process? So today, the management of leases probably doesn't require a certain level of approval that's not visible to management. Maybe you need a workflow process to help you manage that. You certainly need to start collecting all of the data that you need into a system. So for example, you need all the lease terms options and how long they are. You need this interest rate so you can calculate the present value. Capital budget. Today your operating leases are not a capital exercise necessarily, but now maybe they will be because they're going to impact the balance sheet. So think about your capital budget process and how is that going to be incorporated. It's affecting your business line, your accountants, your system support. Are you going to automate the process? Do you have the right system? I'll tell you right now, SAP's Lease solution doesn't work for this. All right? So you have a data conversion exercise that you need to go through in terms of which leases, how many, how am I going to create them, what's the approach for the transition leases. So this is an overview of SAP Solutions. On the upper left, you see some configuration, particularly around the CRM and the lease accounting engine that was put in a number of years ago for lessors. You see on the lower right a little bit of the configuration around the leasee functionality, neither one of these will satisfy the new standard. So you could look at this in any sort of way you wanted, and I have to tell you that the initial pass, I thought, well, it's just a new asset class with a new depreciation key. No. You need the math behind that to calculate that present value. There's not a depreciation key that does that. So that's either going to be a custom program that you write to do it, or you need to look at some solution software that does that. So let me take you back to a slide here, and let me give you an example. Yeah, sorry. So SAP has a solution, and it's broken into two parts. On the left-hand side, you're dealing with the real estate solution. You're the lease. You could be the leaseor, where you're managing your buildings that you lease out, or you're the leasee and you need to manage that building and non-movable equipment. The other solution is the lease administration for equipment. There's a part of a solution in SAP for the leaseor, but there's a solution that meets all the requirements provided by SAP's partner named Nikisa. So my focus really is more on the leasees. I think that's where the biggest impact is. Folks who have the equipment and the management of that, I think that's where the biggest impact is going to be. Let me jump back down to a couple other slides here. Nikisa's the one that's supported and sold by SAP, and yes, unlike the revenue recognition solution that SAP has, which does not cost you additional license costs, it does cost additional licenses as well as the implementation. There's several other companies that are offering a solution. I have not looked into them myself in any level of detail to see how good they are or how well they integrate. My guess is that they would integrate to SAP, but there would be some higher level of cost to do that versus the solution that Nikisa has worked with SAP over the last number of years. So in summary, you really need to get started thinking about this now and getting a project team together. You need to stay up to date with what the discussion is, and FASB and ISB will often put out information about any implementation help around implementing this. Looking at this from a financial and process impact, I can't emphasize enough. And then, of course, looking at the vendor solutions that are out there. I'm not suggesting just the SAP partner, Nikisa. I think you should widen your search and really take a look at this from all views and all perspectives to see which works best for you, depending on whether you have a lot of buildings or a lot of equipment, or both. Here's some resources that you can reference to get into the detail. If you're the kind of person who just has a passion for this, like I do, and wants to read this kind of stuff, or if you just want to read it because it'll put you to sleep instantly, you can do it just before bed. And with that, I will open this up now for questions. I'm Kent Bettisworth. Thank you for taking some time today and learning more about this new way to handle leases. Now I'll throw it back to Diana.
Great, thank you, Kent. Appreciate your time. We do have one more poll question that wasn't released, so I will open that up now. You can please take some time to answer that. And we do welcome questions at this time. So I see people are answering the poll there.
Okay. Yeah, and if you want to share the results of the two polls, this would be a good time to do that.
Yes. 1 second. So it looks like feel free to raise your hand or insert your question in the chat box. Okay, let's see. So for the poll question, does your company have an active project to implement the new lease accounting standard? The 42% said yes and 58% said no.
Okay, awesome.
If you answered yes, 56% replied initial evaluation, 31% said design, 6% said build, another 6% said test.
Okay. So that's a good idea. That actually that's a little bit better numbers than I would expect, and it's a lot better than what I'm seeing on the new revenue recognition standard. The last survey I saw done by PwC on the revenue recognition, about 80% of the companies were still in the initial evaluation. So the fact that 42% have a project team underway, and over half of those, well, a little less than half of those are out of the initial phase is encouraging. I think maybe folks are learning from the revenue recognition standard that there's a lot more to this when you start peeling back the onion and looking at the financial impact, the procedural impact, and the system impact. So is there anything in the discussion around the differences between U.S. and international that anyone would like to ask some clarifying questions about?
Kent, I do have a question here from Frank. He asks, does transfer of ownership enter in anywhere, or is that just implied?
The transfer of ownership is one of the key questions around in the U.S. on whether it's a capital lease or a operating lease. In the international, that no longer applies.
Okay.
So internationally, the transfer of control, a lease is a lease is a lease. They haven't specified that the transfer of control. I'll leave a 1% chance I'm wrong about that, but that's a good question, excellent question, but only applicable to the U.S.
Okay, great, thank you. We have another question here from Jadav. Is S4HANA Finance provide the solution for this lease accounting?
I don't know where it's at on the roadmap for being included, and you're speaking specifically about the Nikisa. So I don't know the answer to that off the top of my head. My guess is yes, but where it's at on the timing, I do not know. For those of you who are looking at the S4HANA, you know that not everything's there yet, and there's a roadmap for what will be converted, what will be transitioned, have a transition period, and what's not coming over at all. I will tell you this: the lease piece of asset accounting is not going to come over to HANA because it's not applicable anymore. So if you are believing that you can use the existing lease functionality for your leases and you're a leasee, and you can use that existing solution, the answer is no, you cannot. It does not meet the new standard.
Okay, great. Thank you, Kent. Does anyone else have any other questions? Now would be the time. Okay, Kent. Well, I appreciate your time. Thank you very much. Thank you, everyone, for joining us, and we hope to see you on our next webinar session.
Thank you, Diana. Thank you, everybody.